Looking at TSM, Taiwan Semiconductors, Trump has continued his war on trade war, and so the futures are going down pretty badly, uh, and Taiwan certainly getting hit, and the market in general. So here's the situation with Taiwan Semiconductors right now. 300 shares in a married put position were bought at 41.93 total price. Okay, and here's the reward to risk graph right now as it stands. Really at the end of the day yesterday, the price of TSM was closed at about what was that, 38.25. Yeah, and now today, this morning, pre-market is trading down in the 37 range. Let's see here, it's bid 37.67, ask 37.97. So it's gone down since last night as part of the whole trade war situation. So looking to hold this through at least dividend date, and dividend date is around June 26th. So far with the married put using this opening price down about $356, something like that. This is including the price of the shares pre-market, and the puts have not adjusted for that yet because they haven't opened trading this morning, so they'll probably move a little bit higher to offset the loss of the shares. We're at 37 in the mid range here, in the high 37s now. That's trading. So here's the situation on the chart. This is a daily chart over the last year or so, and so now we're trading down in this area here. If we look at the probability analysis based on the historical volatility of the stock itself, here we are at June 19th, and the historical volatility would give a range between now and July the 20th, which is the next major options expiration date, of $35.20 to about $40.60, something like that, in that range. It's just based on the historical volatility and projecting a range up and down. August would give us this range, and by October we would expect this kind of a range, 32 to 43. So it makes sense that you'd have wider ranges over longer periods of time. So between now and July, we might expect this range. Here are some of the in a kind of a matrix. So for now the sigma, a 1 sigma move or 1 standard deviation move, this is more like over the next year or so. If I pull this in, we'll see if it will pull in. I can't pull this in to show the next over the entire next year. Here it is through January, which is the expiration date of our puts, and here's through January of 2020. But the expiration of our puts should have this kind of a range from 30 to 44. I'm thinking it'll probably recover at some point and move higher. I don't know if it'll move to 44, but in the meantime, we may be suffering some pain. It may go down to 35.20 or so. And if we look at the chart, which it's having a problem doing. So here's the chart. If you look at it based on the current direction of the chart, you have to think which is more likely for it to hit first, 35.22 or $40.60. These two lines here are the two areas that were shown on the risk graph, the volatility graph earlier. So based on this momentum, it's more likely to head towards 35.20. Here are some moving averages. Got the 50-day exponential moving average. The exponential moving average emphasizes the more recent prices instead of a simple moving average. The 100-day exponential moving average is here. These are drifting lower. 50-day is lower than the 100-day. This indicates overall what we're seeing is the trend is currently down. I was expecting and buying the stock that it was beginning to make a move back up to bend the trend back up. Apparently not happening, especially with the trade wars. So I had to expect a movement down towards 35.22. This would make sense as this was an area of previous support here. It could actually fall down there and exceed that. Here's an area of intermediate support that could actually fall to here and get some traction. The level of volume here was pretty good on this one. Not so much on this one. So this could actually be intermediate target here, which is about 36.62. Now if you think of it also, there'll be a dividend, $1.34 per share, coming up June the 26th. It's only about a little more than less than a week away. That would drop the price of the shares $1.34. So we got 37 currently, trading around 37.70ish or so. $1.34 would drop it to about 36.40, and it would right into that area there, which could be support. But it could fall, continue to fall another dollar or so to 35.22. And so thinking about that, we're currently at a $360 loss on this married put position. Potential of $1,200 loss at expiration in January. And it's not likely to hit 35.22 today, June the 19th, but let's give it a few weeks and say till July the 6th. So I changed the date on this analysis to July the 6th. If the stock just stayed here at 37.97 or so, 37.80 or so, we would have, our loss would have grown by about $50 just by the time value of the puts, the January puts, decaying a little bit. However, if it drops to 35.20 by July the 6th, we will be looking at a $700 loss, $750 loss, which is about double the loss that we're at right now, and well on the way to the $1,200 loss. If it goes to the January expiration, sitting down here, we would realize the full $1,200 loss. So to mitigate this loss here, what I'm proposing is to buy three of these bearish put spreads here. The 37 to 35 put spreads at a debit of around 62 cents is probably likely. It might even be as much as 65 cents depending on where the price of the stock opens this morning. Now what this would do is, again, this is at July the 6th now. I'm trying to project ahead. And at July the 6th, if the price of the shares have gone down to 35.20, we would have just about offset a good bit of any loss that might be incurred by then. So here we have, without this put spread, a $746 loss. With the put spread, if I choose the right one, about a $539 loss versus $458 loss. This takes at sitting here right where we're priced right now on the stock. This is about the loss that we would have because of some time decay in the puts. We go to about $461 instead of the right now we're at June the 16th at that $350 loss. We add these vertical, this put spread, and instead of $740 loss, we'd have about a $538 or $40 loss. So we would have if I just look at this, here is the vertical put spread, the risk to reward just of this spread. And you see, if on July the 6th, if the stock doesn't go anywhere, we'd lose about $50 on this put spread. But if it drops to 35.22, we'd have about a $200 gain on the put spread itself, which would offset losses on the stock. So I would suggest taking what now looks like this, adding the 37.35 debit put spread, or it might be called a bear put spread on your platform. Same number of contracts as the shares that we have. 3 times this bear put spread. Pay about 62, maybe could be as much as 65 cents or so to buy this put spread and offset much of the loss. So then the loss would not be nearly as much. The possible loss by July 20th would not nearly be that $1,200 that we see on the married put position. In the meantime, now this graph here does not consider the dividend, and with 300 shares, $1.34 dividend would be $400. So already this would be offset by the $400 dividend. Remember that the shares would drop another $1.34 from whatever point they're at. So they drop $1.34, and the puts will not make up for it on that date. The puts will already have been priced, have had that dividend priced into them. So this vertical spread here, but it will still help offset any possible continued down move after the dividend. So really what we have here is this loss, $500 something plus the $400 dividend gives about a $130 overall loss at that point. and the shares can still rally back up and bring us back to and above break even. So currently with this situation here, the shares would need to get back to about $41.09 to give us break even on the just the pure stock movement, and that's with this vertical put added in here. With the vertical put, that pushes the break even higher. Without the vertical put spread, we would need to just get to $40.24 for break even, plus add the dividend on top of that. With the vertical put spread in there, we would need to get to about $41.12. This is again all by July the 6th. I'm adding a few weeks in to project a little more realistically. And if the let's say the trade war, there's more resolution, China and U.S. come to some agreements and so forth, then we'll see a better situation. And the TSM might move higher. Uh, and if it continues higher, 44 is a goal over the next year. But I'd just like to see us get back to break even, plus collect that dividend would be nice. In the meantime, we offset the losses. Don't let it get out of control, and actually try to make a little money on the way down. What we're doing is adding some negative delta to this whole situation. Still got still have an $80 delta here. Before that, it's 153 delta. We put in the bear put spread, and that reduces the delta to 80. Now if this continues down, way down, then we're still only at, like here, this far down, we're only at six or $700 possible loss by July. This would be a catastrophic drop. We would not expect that. So that's my recommendation. 3 of the July 37.35 put spreads pay about 62 to 65 cents.